Ian, do you mind providing a summary of your background?
Certainly. Thanks, Todd. So my name is Ian Mullenauer. I'm an associate attorney with Kamen and Cusimano in our Cincinnati, Ohio office. I'm licensed in the states of Ohio and Kentucky and primarily focus my practice in covenant enforcement and litigation matters for the community associations that we represent. Our law firm was founded in Ohio, now represents associations across a few states, but primarily and solely, I should say, represents community associations in their corporate capacity. I attend a lot of meetings with associations and address a lot of different topics, including reserves and things like the blacklist. So happy to have everybody here today, and hopefully we can provide some good information.
Very nice, very nice. Thank you, Ian. And Jerry, a little bit about your background.
Oh, thanks, Todd. My name's Jerry Guesswine. I started my insurance agency right out of college back in 1990. I believe I wrote my first condominium association policy in like 1993. And today, it's pretty much all we do are community associations. And I appreciate you inviting me and look forward to the presentation.
Very nice, Jerry. Very nice, Jerry. Thank you. My quick background, I started conducting reserve studies at Reserve Advisors in 1999. And to this day, I still very much enjoy visiting properties like yours each week. So my job here today is to set the stage for Ian and Jerry. I know this has a lot of information on here, difficult to read. Don't worry about it. We're not going to focus on this slide for very long here, and we'll certainly provide you those slides afterwards so you can review in detail. So how did we get here? How did we get to the point where we're discussing lending and insurance risk as it relates to capital planning? I simply want to note that the upper right highlighted in yellow, that part that's highlighted in yellow, so of those community associations that experienced lender denials, issues with lending institutions, unable to meet insurance requirements, and issues with reserve funding were the top two reasons. And those are the issues we're going to focus on here today. Same comment as that first slide. Lots of information on here. Don't worry about. We'll provide you these slides so you can review in detail. So similar to that previous slide, if you could just focus on that bottom left highlighted in yellow, 93% of communities are seeing an increase in insurance premiums. That alone can make it challenging to properly fund your annual reserve contributions. In fact, we're actually seeing associations now borrowing from their reserves to fund their insurance premium increases in the short term. That obviously diverts funds away from maintaining your property. Those issues have really brought a lot of these topics to the forefront, not just at your communities, but nationally. These topics really now warrant a national attention and a legislative focus. CAI has elevated both insurance-related and reserve funding-related issues to the Federal Housing Finance Agency, and specifically direction towards Fannie Mae and Freddie Mac. The 4 bullets you see listed on your screen represent their list of concerns that they'd like to address. And Ian and Jerry are going to hit upon a number of these concerns here today in a lot more detail. So with that, let's dive into these issues impacting your communities, starting with the mortgage lending side, starting with that challenge as discussed by Ian. Ian, it's all yours.
All right, wonderful. So what is the blacklist? The blacklist is technically considered an ineligible list that's maintained by the federal lenders, Fannie Mae and Freddie Mac. Now, those two entities are government-sponsored enterprises that support the U.S. mortgage market by buying loans from the individual lenders, packaging them into mortgage-backed securities, and then selling them off to investors. Over the course of the last several years, they have really started taking a closer look at condominium associations and the loans that they're giving out for the purchase of those units. There have been a number of things that have contributed to this. I believe most people are going to be aware of the Surfside Tower collapse down in Florida that really kind of put a spotlight on condominium associations throughout the U.S. The ineligible list is going to be a list of those entities, those condominium associations that these institutions have identified as having some sort of issue with the association that would limit the ability to obtain loans through Fannie and Freddie. You'll see on the slide, it's estimated that roughly 5,400 condominium associations across the U.S., roughly 1 million units nationwide are on this list. So it's a pretty big impact. A lot of associations are being impacted by this ineligible list. Unit owners are essentially unable to sell to buyers that are using Fannie or Freddie, which together represent roughly 70% of the mortgage market, which is going to substantially reduce that available buyer pool. Essentially, the purchasers can't get loans through Fannie and Freddie because they won't back the mortgage on that unit. Private mortgage providers are also less likely to provide financing when associations are on this list due to the higher risk that's associated with that association, which again is just going to further decrease the pool of buyers that are potentially able to purchase the units. So we're seeing decreasing buyers markets, dropping home prices, and increased insurance rates that are adding to this problem, really resulting in investor owners being the individuals who are able to purchase these units with cash, which can create a issue with further rentals coming into these associations, since those entities are traditionally going to be purchasing them for investment purposes. This list is going to be maintained by these lending institutions, and it's not something that is necessarily publicly available. Authorized representatives of an association, such as your board members or your attorneys, are able to access the list from the lender's websites and request details as to why you are actually on this list, which can help you figure out how to get off of it. But, we do have that issue of finding out that we're on it in the first place. Thought if you can switch to the next slide. So essentially, why would you end up on the blacklist? You'll see a couple big bullet points here. These are just some of the main reasons why you could end up on the blacklist. Insufficient insurance being one of them. Your association's declaration as well as state law are going to have certain requirements for the type of insurance that your association is going to need. But Freddie and Fannie also have their own requirements. It's something that is not as transparent as we would like it to be. CAI is working towards getting that list of insurance requirements updated to be provided. But insurance is certainly one of the issues. Underfunded reserves. Believe it or not, many associations don't have all the funds available to it right now that it needs to pay for those capital improvements for all the items that the association is responsible for. And that's something that these entities are really closely looking at. It leads to issues of increased chances of deferred maintenance, larger repair bills, and thus special assessments on your owners, which can help lead to delinquency on the payment of their mortgages. Reserve requirements are really going to be based upon your association's declaration as well as your specific state's laws. And it's something that each association's is going to be a little bit different. Would certainly recommend looking at your declaration specifically for reserve requirements, as well as talking to an attorney about what the state law says is required for reserve funding. Some states have very specific requirements, while others, barely talk about it. Speaking of reserve studies, outdated reserve studies are another matter that Freddie and Fannie are looking at. Some states require reserve studies to be updated every certain number of years. Some states require 5, some require 3. It really just depends on the individual state. Recently, Fannie has indicated that reserve studies need to be at least 3 years, if not newer, in order to qualify. And that's something that you're going to have to look at your individual association's declaration and state law as well to determine what that frequency of updating your reserve study needs to be. But when it comes to Freddie and Fannie, it looks like 3 years is kind of the magic number that they're looking for. Another big issue, and something that I already touched on a little bit, is too many rentals. Fannie Mae does not have a specific rental cap. Freddie Mac does. They are capped at 50%. When we have too many rentals, it's no longer owner occupied. It's more of a transient type facility, and they're looking to avoid that. So keeping rentals lower is a good idea. And then the other big one is significant deferred maintenance and structural deficiencies. This is, again, going to lead to a higher chance of special assessment and increased costs for the association that are going to get passed back to the owners at the end of the day, either through special assessment or increase in your monthly assessments. The more that we can focus on keeping maintenance up to date and curing any structural deficiencies are going to help keep us off that list.
Ian, are you seeing one issue more prevalent than the others?
Yeah, certainly. I think that the deferred maintenance and the underfunded reserves are kind of the biggest ones that we've been seeing. A number of these issues are going to come out when you do have purchasers submitting lender questionnaires to the association. That's oftentimes how people are ending up on this blacklist. A purchaser comes in, their lender sends the condominium questionnaire to the association to fill out, which asks a large number of questions, everything from what's the status of your financial accounts, your delinquency numbers, do you have any structural deficiencies, things like that. Associations need to be honest on those. Highly recommend not lying on those just to make sure that the loan goes through. But that's where a lot of these are coming up. Any sort of deferred maintenance and big structural deficiencies that are found through your reserve studies, as well as the underfunding of reserves, are kind of the big ticket items that they're looking at right now.
Very good. Thank you, Ian.
So what can you do to avoid it? Essentially, it's focusing on those kind of big ticket items, making sure that we are operating the association in the most efficient manner as possible while complying with the declaration and state law. Those are the two biggest things that we can do. Funding budgets according to reserve studies as closely as possible. Again, your individual states and your individual associations' declarations may differ, and they do across the country. But the general recommendation is going to be to follow a reserve study. Those are your experts. They are the ones that have the knowledge and come and look at your property, help develop that funding plan for you. And doing so is going to help put you in the best financial position to ensure that you've got the money when it's needed to make those big repairs. Again, updating your reserve study every 3 years. Again, state legislation is going to vary on this, but based on some language from Fannie, it sounds like 3 years is the number that they're looking for. Addressing recommended maintenance and capital repair projects in a timely manner. Again, this is going to not only help ensure that the property is maintained now and is looking nice, so you're attracting those buyers and able to sell the units, but also is going to help reduce the overall costs that come out later on. When you defer maintenance, it only costs you more money down the road. If you don't paint the siding for a couple of years, well, that can help lead to more water intrusion, which leads to the interior damages and things like that, which just increases the cost over time. Consulting with management and your legal counsel to determine strategies for correcting deficiencies. The association's board members are generally volunteers. Not everybody is an expert in property management or construction or financial planning. So utilizing your experts and the resources that you have available to you will be highly important. These individuals are going to help be able to develop these strategies to put the association in the best position moving forward. And then ensuring adequate insurance based on the declaration requirements and state law. Those things are going to have a huge impact on the association. Every association is going to be different in terms of what it's responsible to insure, whether it's just the exterior of the buildings or the interior of units as well. But failure to have the proper insurance is going to cost the association money. I've seen associations that have failed to insure properly and essentially end up self-insuring, where when that insurable event occurs, if they don't have the insurance in place, the association's got to pay for it out of pocket. So we need to make sure that insurance is up to date. And then the last thing that we can do is keeping rentals to a minimum. Again, Freddie has a 50% cap on rentals. Your individual declarations may also put caps on rental limits. But that's going to ensure that the property is mainly owner occupied, keeps the transient nature of the property to a minimum. Owner occupied tends to have more involvement from the owners. They have a little bit more investment in the property since they have money being put into this, and they want to ensure that the property is being upkept in the best way possible. So those are some of the things that we can do to avoid getting on the blacklist in the first place. Getting off the blacklist. So this is kind of the key question here. If you do find yourself on the blacklist, what can we do? Again, you're going to have to find out if you're on the blacklist in the first place. The association's representatives can get on the lenders' websites and access that list for the association. It will provide the reasons that were flagged as to why you were put on the list. Reviewing that and what the reasons for being on the blacklist are going to be of primary importance. We need to understand why we're there and what we need to focus our efforts on. We're going to have to work towards resolving those issues specifically. So if it's a matter of underfunded reserves, well, we're going to need to look at the budget to determine how we can increase the reserve funding to a level where these lenders are going to be comfortable getting the association off the blacklist. If it's something to do with deferred maintenance or structural issues, well, we need to probably get the engineers out to determine what needs to be fixed. How are we going to pay for it? Things like this. So it's not necessarily an overnight fix. It's not just as soon as we identify this issue that we're going to be able to cure it the next day. It takes some time, and it will take, the effort of the association's board, to be in communication with those experts, the legal representation, management companies, different things like that in order to figure out what the best plan of action is to move forward. And that's what we can do.
Ian, real quick question, might be a tough one here. Sorry to put you on the spot. Do you know if individual mortgages can be denied at a community for any of the reasons you listed without the association being on the actual do not lend list?
Yes, they absolutely can. We've seen it before. Individual lenders, not only Freddie and Fannie, but individual lenders are going to have their own requirements. If a particular lender doesn't like the reserve funding level that the association is at, it can deny. Each individual lender is going to have their own requirements, and it's something that are not necessarily stated outright. It's something that you only find out after the fact. Like I said, it's important to answer those lender questionnaires accurately. And if there is a denial, requesting information as to why the denial was made, whether it be through Freddie and Fannie or another private mortgage lender. I recommend looking at the reason for the denial so we can help avoid that moving forward.
Yeah, that's sort of like my last question here. We've seen some mortgages denied because of, for example, poor roof conditions where there was active water infiltration through that roofing system. It sounds like you'd recommend in that case, if you have a mortgage denied for a reason like that, start working with your legal counsel, your management team to try to get the issues resolved.
Yeah, certainly.
Where is Jack? Come get it.
Looking at those things, looking at those specific maintenance items and things and getting those taken care of. Not only can you get that individual denial overturned, if you can fix the leak in the roof quick enough and get it back to the lender saying, hey, this is the work that we've had done or the plan that we have to resolve this issue. Oftentimes you don't even need to have the actual work done. You can just have, the contract signed and they know that it's going to be taken care of. And different things like that. But that's where your management companies, your legal representation are going to be able to help out determining those plans of action.
Very nice. Very nice. Thank you, Ian. Thank you. So we're going to switch over here to Jerry in a moment, as I know this is a super hot topic nationwide, insurance premium, insurance costs. Jerry has some great expertise to provide here today. Jerry, it's all yours.
Thanks, Todd. By the way, I apologize. I don't know if you could tell, but we lost internet connection there for about 5 minutes. I jumped on my phone, and then anyway, we probably lose internet connection twice a year, and sure enough, it just happened. Anyhow, I appreciate it. Thank you. Just kind of jumping on what Ian talked about, from the insurance side of it, some of the requirements that we see that lead to declines. There are two primary, and then there's a couple others that we don't see very often, but the two main ones are 100% replacement cost without depreciation and the property deductible exceeding 5% of the building limit. On the replacement cost, 100% replacement cost, we don't normally see insurers wanting to insure the entire building, at a depreciated cost. What we typically see is when insurers don't have an issue providing replacement costs, but they'll put an endorsement on the policy when the roofs are older. It's a loss limitation endorsement that reduces the roof surface to actual cash value instead of replacement cost. Actual cash value being defined as replacement cost less usable depreciation. Obviously, in those cases, the insurer's not comfortable providing for the roof at replacement cost due to its age. So that's one of the issues that we see. The other main issue that we see is when the property deductible exceeds 5% of the building limit. So when we talk about the building limit, referring to the collective building limits for the association. So for example, if you have 10 buildings in the condominium association and all the buildings are insured for $1 million, you have a collective limit of $10 million. So in that case, the deductible can't exceed 5% or 500,000, being 5% of 10 million. And we don't normally see insurers offering policies with 10 million limits and $500,000 deductibles. However, what we do see we'll see per unit deductibles, particularly in cases where the association may have had claims like water claims. So maybe they had a couple of water claims. So the underwriter says, well, the only way we're going to do this is if we put a $50,000 per unit water damage deductible on the policy. And when that occurs, the lender is going to take the number of units and multiply it by the per unit water damage deductible, in this case, 50,000, and determine whether or not that number exceeds 5% of the collective building limits. That's one area. The other area we see it is with wind hail deductibles. A wind hail deductible is going to be stated typically as a percentage of the building limit. So in that case, it just can't exceed 5%. The other way we see wind hail deductibles is we'll see a flat dollar amount per building. So when it's a flat dollar amount, the same thing applies. They'll take the number of things and multiply it by the flat dollar amount. And if that exceeds 5% of the building limit, that creates an issue and they'll decline. Those are the two main reasons that we see in our area declines. And clearly, we have to make sure that associations are avoiding those whenever possible by setting up the policies correctly. In some cases, though, however, we may run into a situation where we just can't seem to find any insurer that'll provide the coverage that meets either one of those two requirements. The other three, inflation guard is required when it's available in the market. That doesn't normally end up being an issue because typically if it doesn't have inflation guard, we can typically substantiate the values of the buildings to get by that requirement. Special form coverage or its equivalent is required. I don't see this as being an issue, at least in my experience. Most insurers are willing to offer special form coverage. And then the last thing, ordinance or law coverage A, B, and C. They want all three coverage parts included. To my knowledge, they don't specify any specific limits, but they do want to make sure all three of those parts are covered.
Very good. And just one quick note, obviously, depending what state you're in, it might have some different legislation laws that you have to follow. So if you have questions related to your specific state insurance, we'll get you to an insurance provider in that state. We'll get you to an expert in that state.
Okay, moving along here. So what happened to the condo insurance market? Maybe a better question might be what didn't happen. Again, my experience goes back to 1990. In those 35 years, we've had two hard insurance markets, or at least major hard insurance markets. The first of which was 2001 to 2004, which was caused by the 9/11 terrorist attack. That hard market lasted for 3 years, and then the market softened. And the current market that we're in right now, which started in 2019 or right around there. So if you're doing the math, we're still in that market. We're at 6 years, 5.5, 6 years and counting. And to be honest, I feel like I have a decent amount of experience. I've never seen anything like what I've seen over the last few years. Just unbelievable. And I think that when I look at this market, I call it the perfect storm, because in this particular hard market, there were not just one or two factors. There were several factors all coming together at the exact same time to create this insurance market that we have. And I believe that it was particularly hard on condominium associations, because condominium associations are heavy in property insurance. So property was hit the hardest. Factors that contributed: labor shortages, increased material cost, particularly in the construction industry, inflation, adverse weather in certain regions of the country. And then we have catastrophes increasing the cost of reinsurance. So, when condominium associations purchase insurance from retail insurers, those retail insurers are purchasing reinsurance costs from a reinsurance company. And those reinsurance companies have been taking it on the chin with all these catastrophes. And so they're passing these costs onto the retail insurers, and those costs are ultimately trickling down to the condominium associations. So the aftermath, well, what did this all look like? If you're, where the tire meets the road. Several insurance companies exit the condominium association market. Never would have expected that. I saw just a mass exodus. We saw mass policy cancellations. I think back to that, the original slide, the CAI survey, I think it said 47% in 2024, 47% of condo associations received a cancellation or non-renewal notice. That's nearly half. And I get that that's just the respondents, but that's amazing. That's a lot. But that's what we saw in our market as well. This leads to premiums increasing dramatically, capacity issues building for the insurers that remain in the marketplace. Those insurers that are in the market, that remained in the market, had to have product changes evolve so that they could remain affordable. They had to increase deductibles. And, something that I had really never seen in my market before, if I go back 10, 20, 30 years, there were countless number of insurance companies that would provide coverage to a condominium association. They were very vanilla. And so you had such a supply of insurers that when a condominium association had multiple claims, or they had poor risk factors, or aging roofs or anything like this, what I saw was that there was always a company that was willing to offer coverage from the admitted market. And when I say admitted market, I'm referring to the preferred market. That's where the normal condominium association or normal insurance rates come from. When you have a risk that doesn't qualify for the admitted market, then you end up in the non-admitted market. And the non-admitted market, in layman's terms, would be like the high risk market. When you end up in the high risk market, as a condominium association, you're looking at minimum probably 3 times what that association paid in the admitted market. So it's a huge jump. And like I said, years ago, we just didn't have much of a market. I might have seen 2 or 3 admitted or non-admitted policies during my span, and then we get to 2019, and all of a sudden, it's amazing much more relevant the non-admitted market has become, which makes sense when you consider that all these mass policy cancellations are occurring. So all of these associations are being reevaluated by the market. In addition to that, we see a higher level of scrutiny on the physical attributes of the association. So these underwriters, they're not the ones that are still in the marketplace. They tend to they're not insurers that just dabble in condominium associations. These are insurers that either this is all they do or this is a large part of what they do. And as a result, they know the right questions to ask, they know what to look for, and they know when a condominium association is on the good end of the spectrum or the bad end of the spectrum. And as a result, we start to see, for the first time in my career, underwriters requiring reserve studies.
Very good. Real quick, Jerry, is the not admitted market, is that sometimes referred to as the secondary market in some places?
Yeah.
Okay, very good. Very good. Thank you.
Yeah, I think it has a lot of names.
Yeah.
I find that high risk resonates better with people who people who are just not in the insurance industry. It's kind of like auto insurance. You fall to high risk insurance, they know what that means.
Yeah.
At any rate, so reserve studies become much more important. Underwriters using the reserve study as a tool, they're going to use it obviously to confirm some basic information like number of units, number of buildings, what are the amenities? Do they have ponds or other structures or anything like that that makes them unique? But more importantly, they're looking at the condition of the property. The reserve study is going to provide dated photos. It's going to provide the quality of the materials. I mean, are we dealing with 3-tab, shingles? Are we dealing with vinyl siding? Those are the types of things that underwriters are looking at. And in addition, it's going to show the remaining life of those, the roofs, the siding, the windows, pavements, things of that nature. It also may identify mechanical issues that underwriters are particularly interested in, like aluminum wiring, stab lock, Zinsco, or Pushmatic style breakers, polybutylene plumbing. These are all examples of inherent issues within buildings that would automatically send a condominium association to the non-admitted market. And then it could also deal with, provide structural issues, if there's structural issues in the community, things like that. The underwriter also will pair the reserve study with the financial statements. And they're going to look to see if the association is properly funded and also whether their funding meets their reserve study. Are they funding to meet it? Are they catching up? Are they doing anything? And then if they're not meeting it, are they doing anything to catch up? Are they, it kind of gives them a better picture when they compare that with their financial statements. They use it as a risk control tool. They can they can see safety features like, smoke detectors, sprinklers, security systems, and they can also use it to identify hazards. Are they compliant with their pool? Do they have pond signs, signs, around the pond? Are there pavements in the community? One of our lead underwriters, the recommendations and requirements on the reserve study, these came directly from them. They require a reserve study every 3 to 5 years. If it's 30 years or older, it's highly recommended. If it's 50 years or older, it's absolutely required in the last 5 years. And to be honest with you, I see that tightening. I don't see that. I think that's going to get even more stringent as we progress. So, at the end of the day, the reserve study is necessary, but it can be your best friend and it can be your worst enemy. If you've got an association that's in poor condition, it's your worst enemy. It's going to show less desirable community, leads to higher pricing, unfavorable policy terms, and possibly, a decline, to quote from the underwriter. However, if the association's in good condition, it can be your best friend. It sets you apart from other communities. It shows a proactive community, leads an underwriter to more competitive pricing and more beneficial policy terms, coverages, and deductibles.
Nice. Very nice. Thank you, Jerry. Very, very good insight. Just a couple of quick concluding notes here. It's important to make informed decisions come budgeting season. You're in the process of budgeting season right now, not just trying to figure out what projects to take on next year, but also that amount to set aside towards future parent placement, i.e. that annual reserve contribution. A proactive approach to maintaining your communities can help you avoid the lending and insurance related issues that Ian and Jerry noted. The idea is to take a proactive approach where you fix small cracks before they become big cracks. You fix minor issues before those issues become critical, leak into units, and become a major problem. And having that game plan in place to take on these projects in a timely manner, in other words, having a reserve study in place to take on these projects in a timely manner, it really helps you make those informed decisions and stay off of that blacklist and help with to be on that best friend part of the insurance analysis. And so with that, I want to thank everyone for joining us here today. Very much appreciate it. We'll stay on a little bit and try to answer a few of your questions. If we don't get your questions, we'll reach out to you individually and make sure that they are addressed. And again, we'll provide you a recording and also these slides to be able to review at your leisure. Matt, what kind of questions do we have out there?
Thanks, Todd. Yeah, there's some really good questions here. Jerry, let's start with you. We'll start from the bottom here. Can an association expect a reasonable reduction in insurance premiums when all the roofs of the townhome community are replaced with high quality materials?
Reduction, I think that depends on the carrier and the market, meaning the area, the state you're in. I think that my knee-jerk answer to that question would be that you may not necessarily get a reduction in premium, but you may get more favorable terms with your wind hail deductible. Maybe a reduction in the amount per building that the association currently has as their wind hail deductible. I think it would be more in changing in terms than it would be necessarily premium, but it's possible that you could also see a reduction in premium.
Wonderful. Thank you. Ian, I'm going to pivot over to you. There's a few questions that I think speak to the Fannie Freddie blacklist. Concerning outdated reserve studies, this individual, Ray, is in Florida. Reserve studies aren't required for his community, but I think this applies anywhere there's not a reserve study requirement. Where there's not a reserve study requirement, how does that possibly play into Fannie and Freddie's decisions or managing risk with loans?
Mm-hmm. Yeah, certainly. Just because your individual state doesn't require a reserve study doesn't mean that you aren't still subject to the requirements of Fannie and Freddie. They are their own institutions. They can set their own requirements and require that reserve study to be part of the association's package in order to determine that it's a viable candidate for lending. In Ohio, specifically, there is no reserve study requirement. State law does not require it. Some declarations do, but state law does not. The recommendation that we make is that associations perform a reserve study, not only for the budgetary tool, but it also identifies those maintenance items and issues that the property may have that you might not even be aware of. You might not know that there's a hole on the roof or something along those lines. But just because your association is not required under state law to obtain a reserve study doesn't mean that the Freddie and Fannie can't deny the association or put you on a blacklist, since their requirement is that you have one.
Thank you. And along those lines, with reserve funding, who determines what underfunded reserves, how that's defined or that concept when it comes to lending?
That's the $1 million question. It's really going to vary depending on the state that you're in, as well as your individual declaration. So I'm going to give you the typical lawyer answer of it depends. Some states have very defined regulations as to what this is, and other states do not. Again, I'm going to go back to Ohio, for example, since that's where I primarily practice. Ohio's requirement is that an association funds a reserve account to avoid the necessity of special assessments in the future. That is all that it says. Again, there's no reserve study requirement. So how do we know what that funding is? It's by getting a reserve study. You have your experts come and look at your property. They develop that plan for the next 30 or so years. And that's going to be the baseline for what fully funding your reserve account is going to be. If your specific state doesn't have a specific number, which I doubt that they will or should, since every association is different. One association might need $100,000 a year, while another association might need $1 million. So it's very difficult to pinpoint a specific number. So the best thing that you can do is have your experts look at your property, look at your reserve study, and fund according to that.
Perfect. Here's another question. I think, Ian, you could speak to lending, and Jerry, you could speak to the insurance side. But who decides and how do they determine that maintenance is deferred? Reserve studies often suggest that maintenance should be done or it's necessary, but that could be by the book useful life, where the component may not be deemed as needing to be replaced based on its condition at that point in time. So, Ian, could you speak a little bit to whether that comes into play on the lending side, and then Jerry, after that, speak to insurance risk?
Yeah, it certainly can be. Again, it's a little subjective. What is deferred maintenance versus not is going to be somewhat subjective. One person might believe that piece of siding that has a tiny chip in it is, needing to be replaced this second, while another might say it's okay if it waits for a little bit. It's not going to have a material impact on the rest of the building. I would recommend looking at your reserve study. They'll have, the high risk, high importance items. These roofs are 15 years past their expiration date and things like that. And then also having your individual contractors come out, ask them, they're the experts with, even within the field, to be able to say what items need to be focused on now versus what can wait for a little bit. And that's just going to, again, if we can tackle those things in a timely manner, it's going to help reduce the cost overall and help reduce the chance of further damage down the road, based on that maintenance that's needed.
Fantastic. Jerry, does that come into play on the insurance side as well, with how insurance carriers are mitigating risk? I think we've seen in Florida in the past where the useful life, where insurance providers may not guarantee coverage based on the sole age of a roof rather than the condition of the roof.
Oh yeah, I mean, absolutely. So, we have situations where, the roofs are only 15 years old and the underwriters are looking at them and saying, these need to be replaced, for whatever reason. They, could be a lot of different things. It just could be, how they're angled, whatever. But at the end of the day, underwriters are going to be looking for, what is the condition of the property, and does that condition lead to potential loss? And if it does, then that's where they're concerned. So I think a dose of common sense comes into play when you're talking about, risk, and in terms of how it's going to play out. I mean, you could argue that you have, you don't need to do that because you're not supposed to do it for another 10 years, but you don't have any insurance companies that are willing to take your risk because they don't like it. Then I think you need to probably do something.
Absolutely. I'm gonna change course here for another question. I'll leave it up to you all to decide on who wants to tackle this. But and several states have legislation that says a reserve study has to be done every so many years. So in Florida, with structural integrity reserve studies, it's every 10. Reserve studies in Maryland and Virginia is every 5. And there's other states that have requirements there. What's the best practice for an association to ensure that they have an up-to-date reserve study where some of these requirements are saying a study should be 3 to 5 years old, but then state legislation is not reflective of that?
Do you guys mind if I just start before we get to the legal aspect? Do you mind if I just jump in here with a quick note on that?
Certainly.
Just in general, older, more complex communities probably have to get their studies updated more often. If you're an older, complex high-rise, probably every 2 to 3 years. If you're newer or you're less complex, probably best practice is maybe a little bit longer interval, maybe 3 to 5 years. You can get away with something like that. So one of the issues in states that require reserve studies, let's say every 5 years, is that may work for a lot of communities, but there isn't a one size fits all update interval. So in those states, those older, more complex communities are probably waiting a little bit too long. So I don't know where this is going to go with Fannie and Freddie now pushing this 3 years or less. Conflicting now with some of the states' legislation. But I just wanted to note that out there, that there isn't a one size fits all update interval. And I don't know if you have any thoughts on that from the legal aspect.
Yeah, I mean, from the legal side of things, the association is obligated to follow your state's law and your declaration. You're not going to get in trouble if you do it every 3 years, but your state law requires it every 10. By doing it sooner, like Todd said, especially for those more complex or older communities, that's going to help give you a better understanding of where the property currently sits, but also help comply with some of these requirements from Freddie and Fannie. So legally speaking, follow your state law, follow your declaration. I'll be interested to see what happens with CAI's efforts of getting in touch with these institutions to try and establish some of these protocols and things. And that would, I imagine, be something that can be and should be addressed, is that there is this discrepancy. Every state's different, and like Todd said, every association is different. So it is really difficult to kind of get a one size fits all requirement in place that actually is going to benefit everybody. So I'll be interested to see what comes out of that conversation over the next couple of years.
Perfect.
Tom, I
Thank you.
think on the insurance side, I think you could have a reserve study done every 2 years, but if you're not following it or you're not taking care of your property, you're going to have insurance issues.
Absolutely. Another question here, Ian, we're going to pivot back to you. There's a couple questions on if we could revisit, how do we determine if our association's on the blacklist? And then if we have another attendee that their insurance broker is actually having a hard time getting access to the blacklist, do you have a recommendation on next steps?
Yeah, so I believe on one of the first slides that was presented, there is a link. I don't know if that's going to be, the link is going to be available when we send the slides out or not. But if you Google Fannie Mae condominium blacklisted, it will take you to the Fannie Mae website, which does have a link to that. There is a form that's filled out by one of the association's representatives, whether that be a board member, legal counsel. I'm not sure if insurance providers are going to count towards that or not. But when you fill that out, that should provide you access with your association's information regarding your status on the blacklist, whether you are on or not, and then as well as what the reason is for why you're there.
Fantastic. Thank you. Todd, we'll pivot over to reserve studies here for a second. Jennifer's asking, why is a reserve study not considered a building inspection by a licensed architect or engineer?
Yeah, that's a good question. This sounds like maybe possibly a state specific. And is this question in context to filling out the Fannie Freddie the questionnaire? I can really only speak to the areas that I primarily work. That question, reserve study inspections are provided as part of that questionnaire as a property condition assessment. They do count in the areas that I work in, but that might be more a legal question for your specific state.
Fantastic. Thanks, Todd. We got a couple more questions. You guys want to stick on for a couple more minutes and address a couple more questions? I don't think we'll get through all of them.
Sure. Maybe a couple more minutes.
Okay.
Sounds good.
Okay. Are associations legally obligated to intervene and address issues when there's a one-off loan denial?
You said, are you legally obligated to intervene when there's a one-off denial?
Correct.
It's something that again, you would have to look at your specific state law and case law in that specific state. It's difficult to say for certain. My recommendation would be, if you find that there is a denial, like I discussed earlier, figuring out why that denial was in place. chances are if there's one, there's going to be more. And once the association becomes aware and the board is aware of a defect in the property that is impacting the owner's ability to sell, there's going to be some increased responsibility to take some sort of action. The association's primary purpose is for the preservation of property values and the upkeep of the property. So if there's something that is impacting property values, inability to sell through certain lenders, then yes, we should probably take a look at it and figure out why we are there, what we can do to resolve this issue. It might be the chance that there's just a one-off private mortgage lender that just doesn't like condominium associations and says, no, I'm not doing it. In which case there's not much that we can do about that. But if there is something, a roof that needs to be replaced, there's deferred maintenance, there's a structural issue, underfunded reserves, and that's causing those denials, then we should work towards resolution on that.
Great. Ian, sticking with the mortgage side of things regarding rentals, does it matter? Does it come into play whether rentals are daily, weekly, or monthly rentals?
I don't believe so. I think it's just the number of units that are not owner occupied. Every association's declaration is going to be different regarding rental ability. We have plenty of associations that don't allow rentals whatsoever, and then we have others that allow Airbnb, and that's kind of all the owner's primary focus. We've got some downtown associations that it seems like 80-90% of the owners are renting out for Airbnb and use it on the weekends that they're in town. So it's really going to depend on your individual association as to what's actually permissible. But as far as the lenders are concerned, they're primarily looking at owner occupancy. So if there's rental of any kind, that's going to count towards the rental capacity.
Thank you. Jerry, we'll pivot over. Here's another insurance question. Diane has a smaller association, 20 units, 10 buildings in each. They're really side-by-side dwellings. Their insurance premiums have increased significantly because they're kind of being lumped into the typical multifamily condo complexes. Do you have any recommendations for them and what they could do to pursue or address the increase in insurance?
So are they a condo complex or no?
And Diane, I don't know if you're still on the call, but if you could clarify if they're legally a condo association. We can come back to that in case Diane's not on the call. But if she does answer, we can circle back to that one. Let's continue on the insurance side. Ted has asked if the installation of a flood barrier will result in reduced insurance premiums.
Honestly, that is probably out of my league. In my state, I don't really deal with flood in particular, but that sounds like more of a specific question for somebody in another state. I apologize.
That's okay.
We'll get those state-specific questions. We'll make sure somebody addresses your questions for sure. We'll get to the right state for sure.
Oh.
Matt, just to be respectful, we can certainly, I know we've been on here quite a while. Jerry, Ian, very much appreciate your time. We'll send any additional questions your way, and we'll make sure we address everyone's concerns. But again, I very much appreciate everyone joining us here today.
Yes, Todd, Ian, Jerry, thank you for your time.
Thank you.
Thank you.
Thanks for having us. Appreciate it.
You're welcome. Bye-bye.